that. So that's a view coming in on India. But let's get down to the market opening now, which will open in about 10 seconds. Looks like it's going to be a decent opening. There is a bounce coming for sure. The Nifty is indicating a start above that 19,300 mark, led largely by names like Hindalco, SBI, Tata Steel, HDFC Bank and Adani Enterprises. So that is the first tick on the index. You have the Midcap index also, which is rising actually, up 176 points, now 186. 190 now on the mid-cap index, and there 200 points higher on the mid-cap index. So 0.5% rally, good green opening across indices, Sensex, Nifty, mid-cap, Bank Nifty, all in the green. The advance decline ratio is also well in favor of advances at 3:1. Now, if you look at the Bank Nifty, it's batting for the bulls this morning, up almost 190 points. And then let's take it straight to the individual banking names. There's SBI, HDFC Bank that is up in the green. Bajaj Finserv from financials is higher as well. And Maruti Suzuki comes out with its numbers this week. The stock is up about 0.4%. Hero MotoCorp, TCS, Divi's, HUL are a couple of stocks in the green. On the red side, there's NTPC down about 1.5%. There's news flow on that one. Infosys, in fact, a lot of IT stocks are under a bit of pressure. Starting with Infosys, there's Tech Mahindra that comes out with numbers later in the evening, so keep an eye out on that one. Britannia, HDFC Life, Power Grid, Cipla are a couple of other stocks that are just a tad bit in the red. But otherwise, it's a decent-looking market opening, you'd have to say. 50 points higher on the Nifty now and 150 points higher on the Sensex. Let's see how long this green lasts.
Well, indeed. A few stocks in focus, though, Sonia. Delta Corp, the one that's corrected more than 35% in this year itself. Well, that stock is up close to around 6% because they've got some relief from the courtrooms. So good on them. That stock is holding well in the green. Genius Power, that's another big winner. It's up close to around 5%. It corrected in Monday's trading session, so that bounces back. NCC Limited, well, that's up close to 3.5%. And Union Bank as well is higher in trade today. NTPC, well, Nimish had highlighted that note by Bernstein. Listing of the renewables business may not be the best thing for them. That's at least what Bernstein believes. That stock is down close to around 1% as we speak. Other big movers from the broader markets, let's pull up a few of them. Sri Renuka, that's up close to around 4%. So that's moving well. South Indian Bank, volumes very, very high. That's up 3.5% as we speak. And a couple of other notable movers. India Bulls Housing Finance took a sharp knock. Well, that's pulled back as well. And MMTC, we've been warning you about some of these low float companies. Just in the last 5 sessions, I think the stock has corrected from around 85 rupees to around 57 rupees. Zomato as well, catching its breath, it seems. That stock is down close to around 3% as we speak. But a decent opening, Prashant, almost in line with what the Gift Nifty was suggesting.
Yeah.
The Nifty Bank, that's the key one in there, and the Nifty Financial Services Index. Because in the final hour of trade on Monday, both of them did see a sharp decline. Both of them have bounced back a little bit this morning.
Yeah, no, absolutely, Nigel. So it's about 40 points right now on the Nifty. We're at about 19,322. By the way, market breadth is maybe things will improve a little bit. 200 higher and 1,700 lower. By the time we left off at 3:30 on Monday, advanced decline was 10:1 in favor of declines. I mean, this is just still early, but it's deeply in the negative. Market breadth, that is. There you go. All right, we'll come back to this in just a bit from now. I think we mentioned Zomato is the top volume traded stock coming up on your screen. Varun Beverages is down about 0.75%. This is, I'm kind of sorting this by volumes. So Credit Access is down about 2% or so. I think Orissa Mine sold off sharply on Monday. It's down another 2.5%. There is NTPC, as Nimesh was highlighting, 1.25% lower. Paytm, I think, sold off sharply on Monday. It's down another 1.5%. Supreme Industries, it had that flash move to almost, I think, closer to 5,000 bucks. I think it's back to about 4,200, down another 2%. Lodha, that is Macrotech, is down about 2%. Max Healthcare is down about 2%. Policy Bazaar will come up on your screen, 4% loss there. From levels of what? I mean, almost 820, 830. 2 weeks back, it's down to about 670 now. That is Policy Bazaar. Mahindra Logistics reported numbers. I think numbers are a little... it's not exactly great numbers, but 4% lower on Mahindra Logistics. So yeah, I mean, there is a fair bit happening and things are moving around quite a bit. But on the upside, apart from what my colleagues mentioned, Delta Corp, 5%, almost 5% higher. Suzlon continues to, inch higher, about 4% up. Stocks at about 33 plus now, consistently comes up with, in terms of large volumes. Union Bank, Indian Overseas Bank, UCO Bank, Central Bank, the entire public sector bank space is coming up with some gains as well. So it's not a bad-looking screen. And I just want to put out KDDL, that is Kamla Dials, which is coming up with 11% gain. So that's a big one that we have at this point. So 36 points. It's a decent start after a complete carnage on Monday. So we'll see watch levels closely. 19,323 is what you have. Pankaj Tibrewal is with us, Senior Executive Vice President and Fund Manager Equity at Kotak Mahindra Asset Management Company. I mean, the folks over at Kotak have been warning of the euphoria in the mid and small cap space, Pankaj. So, well advised consistently for some time now. But just comment on what we saw on Monday. Were you surprised? That question, who sold? Because you get the net flow numbers, and both FIs and DIs did not. So if you want to just start there, go on.
Good morning, Prashant. If you remember our last interaction, many of the data points have been suggesting that the valuation of small cap and micro caps have been in a frothy zone. And if you look at the breadth from the day the first crack happened, which was 12th of September, the breadth has been extremely poor. And that was also witnessed in the month of September, that the median stock return of small cap index was negative, whereas the index was positive. So the rally was getting narrower and narrower. And on Monday, it was the worst breadth of 2023, where almost 1,200 plus stocks had 3% plus kind of a drawdown. So I think the breadth is getting a little worse. And these are the first indications that people are kind of worried on this small cap, micro cap, and mid cap universe. The other data points to watch out is that the large caps have become much more reasonable. And if you look at any data points, either be large cap universe to GDP or large cap universe to overall market cap ratios, I think all of them are suggesting that they are in a reasonable valuation zone compared to mid and small cap category. The third data point, if you look at since September 2021, the large cap universe is up by almost 13%, the market cap. And if you look at their aggregate profit growth, it's up more than 40%. So there has been a derating in the large cap. And almost in our calculation, more than 40% of Nifty stocks have not participated from the run from 15.5, 16,000 to 19,000, which provides cushion on the downside. So we believe that at this point of time, there are few lessons which one needs to implement from the past cycles of 2007-8, 2017-18, that one must not ignore quality. I think quality anchoring at this stage is extremely important. Broken balance sheets, broken businesses should be avoided. Leverage should be avoided at any cost. Also, one should be in the market, in stocks, and stock selection should be very selective, where there's earnings visibility and predictability, and making sure that asset allocation is the way to go.
Okay, by the way, the metal stocks are the flavor of the moment. So Hindalco, Tata Steel, JSW Steel are all your big gainers this morning, and up anywhere between 1.5 to 3% odd. So keep that on your radar. And on the downside, you have a couple of the pharma names, Divi's Lab, Cipla, Apollo Hospitals, that are all in the red. Pankaj, good morning and thanks for being with us. How are you feeling about the global situation now in the context of how one should approach this market for the rest of the year? Do you think time has come to take some money off the table, perhaps move to cash because of the risk aversion globally towards equities?
Yes, Sonia, I think what we are seeing is that there are geopolitical risks which are, kind of increasing. Last year, it started with Ukraine, Russia. Now the Middle East, the Israel-Palestine or the Gaza part is creating some kind of a nervousness. On the other side, you are looking at the 5% bond yield. And if you look at since September of 21, the correlation between bond yields to Nifty earnings yield has been a staggering 85%. It has not been so highly correlated. So from a valuation perspective, also globally and locally, we need to be careful that the cost of capital has gone up materially in the last 2 years, and that may provide a headwind to the risk asset classes like equities, for example. So one needs to be extremely selective, and also one needs to keep a very close watch on the global developments which are happening in front of us, right from the China slowdown to the Middle East crisis, to the bond yields in US. All are the headwinds one we need to carefully watch out. And in domestic arena, you have elections, the state elections, 5 state elections in the month of November, December, followed by the general election. So our sense is that volatility will pick up and one needs to carefully navigate in the short term.
Hi, Pankaj. Good morning. You have been warning us with regard to the broader markets getting overheated, and it's playing out in that way. So to call it, you'll realize those that were flying without floats in the deep, at these crucial junctures. And you put it very, very well in that tweet that you put out, that PE is not just price to earnings, but promoter ethics as well. Capital allocation is very, very important. So, those are important points that are made with regard to the broader market stocks. But tell us about earnings as well, because that's going to be the most important, right? Fundamentally, if earnings continue to compound, then no worries in the Indian markets. And that's what most are counting on. How has earnings season panned out? And do you think that mid-teens earnings growth on the Nifty stocks is at risk?
Good morning, Nigel. On the earnings side, if you look at the NSE 500 universe, which we track very closely, till yesterday, 90 companies have reported. Out of that, 62 are non-BFSI and 28 are BFSI. And these 28 companies have reported 40% earnings growth, whereas the non-BFSI, the 62 companies, have reported 18% earnings growth. And on an aggregate basis, these 90 companies of NSE 500 companies have reported 28% earnings growth. And the clear sign is that lower revenue growth, but we have seen margin expansion. Out of the 62 non-BFSI companies reported till now, 36 of them have seen margin expansion. So probably in our view, this may be the last quarter where you see massive margin expansion due to lower raw material cost. Now, as crude has inched up over the last couple of months, probably that will be on the margins in the third quarter. But still, we will see year-on-year margin expansion even in the third quarter. So our sense is that the mid-teens earnings growth on Nifty probably looks to be a reasonable ask. I don't think a bigger risk on that side, but don't ignore the fact that over the last 2-3 months, except BFSI and autos, most of the other sectors have seen earnings downgrade. And in this quarter also, IT especially has seen earnings downgrade. FMCG, whatever little number of companies have reported, they have seen some kind of earnings disappointment. So we need to watch out the earnings trajectory very closely. Early days in the second quarter, but 90 companies have given some kind of a direction, that 28% earnings growth with lower kind of a revenue growth.
Okay,
watch out the markets. Watch out for the markets. Pankaj, we're just coming back to you. We've moved into the red actually, and stocks like Divi's, Apollo Hospitals, HDFC Life. Just get some of these intraday charts up for you on the screen. The Nifty has moved into the red. The Midcap index has moved into the red as well. And the advanced decline ratio that was looking very, very good just a few minutes ago, that's narrowed down as well. Sonia, I just caught my attention.
Yes. In fact, if you look at the broader markets, there are a lot of stocks that are now seeing about 4-5% losses, right? So you look at something like an MMTC, something like, a whole host of these stocks actually in the broader markets, all the vulnerable names are under pressure. And the market overall has also come off from the day's highs quite a bit. The Nifty now well below that 19,300 mark.
Sonia, typically what happens is that after very sharp falls, usually you see the next day there is because there could be margin calls. All of that happens till about 11 o'clock. And then after that, you get a better, clearer kind of a picture. All of that, correction and the allied damage, etc., is cleaned off, and then you kind of take a fresher kind of a view. So, in a way, to be expected. In any case, the bounce as we've been outlining, call it a tactical bounce. Would it be a few hours, not even a few hours old? We'll see. My sense is perhaps, once this clears out, there is a bounce. And the 35-40 points that we saw is not it. So let's see. 19,273 is where the Nifty is at right now. Pankaj, sorry, just to come back to you. Did you say that when you were describing earnings and what we've seen so far for BFSI and non-BFSI, for the non-BFSI, the trajectory is looking worrying? Is that your conclusion?
No, Prashant. I think if you look at the last quarter, even in the first quarter, after FY23, we saw the first quarter in FY24 where broader markets earning was quite good, which is especially the non-BFSI segment. But only point to just keep in mind is that if you segregate the NSE 500 companies into two buckets, the BFSI, which are about 77 stocks, and 423 stocks, which are non-BFSI. Non-BFSI valuations are at about 80% premium to the BFSI bucket. So BFSI actually has got derated over the last couple of years, despite of very strong earnings growth. And when you kind of bucket it out into two different parts, non-BFSI and BFSI, you kind of understand that a lot of market is pricing in a very sharp earnings growth. So one should be, kind of careful in that way that the expectations are very high running into the second and the third quarter results for the non-BFSI space. But having said that, early days still, only 90 companies of NSE 500 companies have reported. Earnings have been good, 18% earnings growth in line with expectation. Let's watch out for the remainder of the earnings season.
Okay, by the way, the Midcap index is selling off quite rapidly now, so don't lose sight of that. 100 points gone on the Midcap index already, and lots of individual stocks in terms of both volume and price action on the downside. So, if you look at something like a Vodafone, it's down 1.5%, Zomato is down 1%, Bajaj Hindustan is down 0.6%, and lots in the infrastructure space like BHEL as well under pressure now. Pankaj, how are you feeling about IT post the earnings that we've seen so far? Would you put any fresh money to work here, or are you still cautious on this sector?
Sonia, as expected, I think we have seen earnings downgrade in the second quarter of most of the large IT companies who have reported. And the outlook also for the remainder of the year doesn't seem to be inspiring. However, the only positive is that the order inflow continues to be strong, and which gives us hope that FY25 would be a very strong year in terms of growth compared to FY24. So over the next 3 to 6 months, we'll scout for opportunities out there. And we believe that 25 is the year one should be playing for IT. And there, I think if valuations have become reasonable, we would look to reduce our underweight, which is there across most of our portfolios in IT right now.
Okay, all right. Pankaj, final question before we let you go. We are going to be approaching state elections and the general elections as well. And rural India has been struggling a fair bit. Do you think, since the government is likely to try to boost that part of the economy up, would you play some of these names, maybe the consumer names, I don't know, the two-wheeler names, some of them have already done quite well?
So Nigel, if you look at the data points, at one point we were worried about the monsoon progress. But somewhere the monsoon has ended at about 95% to long-term averages, which is not bad. The only worrying point is that the water reservoirs are at about 73-74% compared to last 10-year averages of about 90%. So that may have some impact on Rabi crop. So just keep that in mind. However, if you look at the past data, 6 months before the election, 6 months after the elections, actually the money gets spent at the ground level. And don't forget, this time there are two more things. The festivity has been pushed to the third quarter, which was last year in the second quarter. And third is that the marriage season is very heavy, about almost 35 days of marriage season this time around, which is one of the, itself in an industry in itself. So I think if you look from a next 12 months perspective, many consumer discretionary names in this correction probably will be looking attractive, which have strong franchises and strong balance sheet and cash flows.
Okay, well, it was great speaking with you, Pankaj. Have a good week, and thanks for joining in and speaking to CNBC-TV18. Well, that's the word on the market, but let's move on. JSW Energy is the company on our radar now. Very good quarter, actually. Strong merchant power sales. The volumes were good, coupled with higher realizations. The margins improved because of lower raw material costs. So all in all, nothing to complain. The stock is down 1.5%. The market is under pressure, so maybe some profit taking there. Prashant Jain, the joint MD and CEO at JSW Energy, is joining us now to talk more about the numbers. Prashant, thanks a lot for joining in. On all aspects, if you look at it, it was a very good quarter this time. But just give us a sense of how the demand trends are shaping up at the moment. The merchant power trend has picked up quite a bit over the last couple of quarters. But what is the kind of market pricing that we are looking at? What is the kind of up move that you're seeing in terms of demand over the next few quarters?
Yeah, hi, good morning. So demand is quite robust. During the quarter gone by, the power demand was up by 13%. And as we are speaking in the October month, till date, the power demand is up by 19% in the month of October. So I think there is too much of government spending which is happening. There is a lot of capital expenditure which is going on, underlying demand for other items are quite robust, and that is what is reflecting in power demand. So power demand is quite robust, and that is also reflecting into the peak shortages, which we saw in the previous, 2003 to 2008 kind of a scenario where we saw the similar kind of a deficit, and now the grid size is almost 3x of the grid size which it was at that point of time. So the demand is quite good, and we feel that merchant tariffs will be elevated.
That was my next question. So merchant tariffs at the moment, I think, are at about a little over 8 rupees a unit. What is the expectation as we move along into the fag end of the year, and by the end of the fiscal year as well? What are we looking at in terms of pricing?
It's very difficult to talk about the pricing, but one thing one should also remember that the coal prices are also very high now. With the oil inching to $95, the coal prices have already shot up to $135, and so that is also putting a lot of cost pressure overall. And there are the inflationary pressures globally, and all that is putting a pressure on the energy side also. And that's what we feel that because of all these reasons, the prices of merchant power will be elevated, but we don't know that what kind of a profitability it will entail to the companies who are into the merchant power sales.
All right. Hi, Prashant. Good morning, and thanks so much for joining in. We need to address all aspects of the stock. So you're giving us an outlook operationally. The markets were weak on Monday, so maybe that's why the stock was under some pressure. But there were some rumors as well that was doing the rounds. I need to put this to you so that we clear that rumor. You have any plans of moving on from the company, or are you sticking with JSW Energy? Because that was a rumor that was doing the rounds on Monday.
So I'm not sure about the rumors which are there in the market, and we would not like to speculate anything and would not like to comment on any kind of a speculation. As we speak, that I'm the joint managing director and CEO of the company, and there is nothing as such.
Okay, good. So no plans of moving on. We'll take that. We'll take your word for it as of now. Let's focus on business then. The short-term sales of the merchant power, they accounted for roughly around 200 crores on the EBITDA front for the past quarter. Now, give and take everything, do you think on an annualized basis, short-term EBITDA could contribute, say, around 700 crores, given the kind of challenges that you have, the seasonal aspect as well? I'm just trying to analyze that number.
So, Nigel, it is very difficult to talk about the kind of a EBITDA contribution which can come from the merchant sales. But what I can talk about is that right now we are having a open capacity which is close to 800 odd megawatt, which is existing capacity, and there is another 700 odd megawatt which will be getting on stream during the current financial year. So that is the open capacity which we will be using to cater to the market. And as I said in the previous question also, that there are the inflationary pressure on the coal side of cost also. And it's very, very highly unpredictable to project that what will be the power prices going forward. So, but we will be able to capitalize on the dark spread, whatever will be available into the market going forward.
Okay, and in Bharat, that is around, I think, 700 megawatt, right? That gets commissioned sometime towards the end of this fiscal or the start of next fiscal. On an annualized basis, what could that contribute on an EBITDA basis, going by current pricing? Things could change, but as things stand, what could in Bharat contribute? Because we're looking at it from FY25 basis.
So what I can say that the in Bharat contribution will be little higher than the other two plants which we are having at this point of time, because they are based on the imported coal, whereas the in Bharat will be based on the domestic coal, and it is situated between the, in the coal belt area. And because of that, the fuel price at in Bharat will be a little lower than these plants by, you can say, in terms of the percentage, it will be 40-45% lower. And so that will be giving a little higher contribution. And then accordingly, it can be estimated, whatever it will be the merchant sales price.
Got it. Mr. Jain, hi, good morning. Prashant here. Could you talk to us a little bit about what are the plans for value unlocking in JSW Neo? I mean, will we see a IPO? Will we see strategic investors coming in? Is due diligence on? By when can we expect an announcement?
So, hi, good morning, Prashant. So, we are, as we have been maintaining the stance that we are looking to evaluate all kind of proposals which are on the table. And the structure side, we are absolutely ready. And at some point of time, whenever we see it deem fit, the board is going to consider either of the options which you have stipulated. And as and when such kind of a situation happen, then we will be certainly talking to you.
Sorry to press you a little bit. I mean, give us what you can, I guess. But will we see something this year, sir? Or and are investors already taking a look at it? Is due diligence on in full swing?
So, as I said, that we don't have any kind of a timelines. We don't have a plan to, which is totally fixed. But, we are really mindful about the growth of the company. We are a growth company. Right now, we are generating enough cash to fuel our growth, but we see the size of opportunity is pretty huge, and we can accelerate the growth going forward, provided we have more equity on the table. And for that, we need to have like-minded partners in synchronization for that kind of a growth for next 1 decade. So as and when something like that is materialized, then we will be putting it to the board, and then board is going to take a call on that part. So there is no firm timelines, but yes, it will happen.
Okay. Just one last point on this. Bernstein, just completely incidental, but Bernstein this morning put out a note, not on JSW, but on NTPC. And they, their thinking is that for NTPC, again, there's been a buzz that there'll be the renewable business will be spun out and listed separately, etc. They say it's not advisable. And they say that globally, we've seen many of these things happen, and then eventually, after a few years, these entities are remerged. They come back into the parent fold. Large reason essentially is because the renewable business has got large cash infusion needs to build it up, etc. And that is best done funded through the cash of the thermal business, because that is still the mainstay for most. I just wanted your thoughts, sir. And how would you? Are there any takeaways for you when you're thinking about this? The options are open. You're not decided, but any thoughts?
So as of now, what I say that in case of JSW Energy, so far we have been utilizing the thermal business cash flow to fuel the growth of the renewable business. And as the power shortage is coming up, there are the opportunities to grow the... Yeah.
Sorry, go on, Mr. Jain.
Yeah, so there are the opportunities to grow the thermal business also, and as and when there are the enough opportunities which are coming up, we will be looking at the thermal business also. But I don't see that the thermal business is going away anywhere in next 1 or 2 decades.
Okay, all right. So, there is a very high visibility from within the JSW group in terms of capacity addition. Just wanted to understand from you, what is the capacity that we're looking at over the next, say, 5 to 10 years? What is the targeted IRR for this capacity? What kind of pricing? If you can just give us a roadmap over the next, 5 to 10 years.
Yeah. So basically, JSW Group is a growth-oriented group, and then we have been looking at various opportunities within the group for from the decarbonization perspective. And in that aspect, JSW Steel, which is having a short-term to medium-term plan to go up to 50 million ton and eventually to 100 million ton, and we realize that in next 3 to 5-6 years, there are the opportunities to do close to 6.2 gigawatt of the renewable capacity for the group. And in addition to that, in order to make the green steel, they will be requiring close to 85-90,000 tons of the green hydrogen, which will also require close to 1.8 gigawatt of the renewable capacity, and plus around 3 gigawatt hour of the storage application. And all this, we are expecting that we will be doing by 2030. With regards to pricing and equity IRRs, it will be at arm's length, will be discovered between the two companies together. Historically, we have been seeing that whatever projects we have been doing in JSW Energy, our threshold has been 15% equity IRR post-tax minimum.
Okay, 15%. So you'll hold on to that 15% IRR for this entire, 100 million ton, the journey from 50 to 100 million ton that you're talking about.
Yeah.
Okay. I just had one more word in terms of margins. We've seen the way coal prices have softened from the recent peak. So just trying to understand, what are you targeting in terms of EBITDA margins for the full year for FY24 and for 25?
So we don't look at the EBITDA margin because, power is a very different kind of a business where, in case of our PPA tied up business, we are going to get the fixed cost recovery. In case of renewable business, the EBITDA margins are 80-85%. That is also the complete fixed cost recovery because there is no variable cost. It's only the dark spread which is relevant, which is in case of the merchant tariff, which we explained about the open capacity. So that is totally dependent upon what are the market conditions, and depending upon 1 rupee to 5 rupee, this spread can be taken.
All right, very quickly, Prashant, y'all had the edge with regard to sourcing some coal from Russia as well. Is that still on? If you could tell us how much of your coal requirement is coming in from Russia?
I won't have the absolute number right now, but yes, we have been really agnostic about the location, and we have
Okay.
been looking at. We see if there are opportunity from Indonesia or South Africa or Australia or Russia, wherever we are getting the cheaper coal on a variable cost perspective, we just go and latch it on. And so historically, we have been buying coal from Russia, and which have been proven to be the cheaper to us. But right now, in last 1.5 months, we have seen that the Russian coal prices are at par with other sources.
All right, Prashant, thanks so much for joining in, giving us an outlook on business and also clarifying that as of now, there are no plans to move on. So we're taking your word for that. Well, on that note, though, we'll slip into a short break. When you come back, we'll be joined by the management of Mahindra Holidays and Resorts. Stay with us.
Nita Mukesh Ambani, the founder of Reliance Foundation, speaks about her new cultural center.
It's taken us now a decade to bring this to life, to show the best of India to the world and get the best of the world to India.
On the Reliance Foundation,
A nation's development depends on women empowerment and the well-being of its children.
on family,
I am so blessed to have Mukesh, who is my best friend and my life partner.
Nita Mukesh Ambani sits down for the CNBC conversation.
Okay, welcome back. We've got the market which has come up, as I was saying. I mean, there was a sharp dip which came through, but unlikely that is, the 35-40 point higher start was all the bounce there is. There is more there, but will we get it today or perhaps over the next couple of days? We'll see. But for now, it's about 35-40 points. Sentiment is still fragile, and that likely is the case. And conviction levels, etc., remain pretty low. But you know that doesn't that cannot rule out a tactical bounce. 19,322 is where we are at on the Nifty at this point in time. We'll come back to stocks because lots of new stuff is moving and is in the mix now, but in a bit from now. Mahindra Holidays is on our radar now. The company's second quarter earnings performance has been a bit weak despite improvement in the European business. Their profits declined due to lower other income and higher depreciation. Mr. Kavinder Singh is Managing Director and CEO at Mahindra Holidays and Resorts, and he's joining us now to take some questions. Mr. Singh, good morning. Good to have you with us here. Prashant this side, thanks very much for being here on CNBC-TV18. So if we can start by asking you, what was the occupancy in the non-Uttarakhand and Himachal properties in the second quarter? And what are the occupancies tracking at so far in the third quarter?
So if you were to look at the occupancies excluding Uttarakhand and Himachal, we were well above 80%. And as we are looking at quarter three, it's looking very robust. It's a seasonally good quarter. So last year we were at about 84-85%. We are likely to cross those occupancies as we look into this quarter three.
So, sir, good morning and thanks for joining in. So occupancies are, I think, around 78% right now. As an average, what are we looking at by the end of FY24? What is the average occupancy level that you're going to be clocking?
So, as I mentioned, the occupancies excluding the Uttarakhand and Himachal would have been above 80%. But because of the landslides and heavy rains, we were at about 77% for this quarter. Next quarter, we are looking at about 84-85%. And for the year, we will be well above 80%. It could be 82 or 83%. And mind you, this is on an increased base because a lot of our new inventory came in quarter four. So we are tracking at much higher number of room nights compared to the last year. So while the occupancy figures would be in the region of 83-84%, but the number of room nights are going by already 10 to 12%.
Okay, so what are we looking at in terms of membership additions? In Q2, I think it was just a little under 5,000 members. Is that a quarterly run rate that you hope to maintain for the next few quarters as well?
We are aiming to be much higher than 1,000. I want to mention this to you that this quarter we ended up doing the highest ever member additions in quarter two. We were able to grow our member base on YOY basis by 11%. Our upgrades were up by about 15%, which shows that the members have confidence in our business and they're upgrading their memberships. So overall, member addition story is opening up. It's accelerating. And by the way, I have already mentioned that we have plans to go from 5,000 rooms to 10,000 rooms in the next 7 years. And pursuant to that, we have 690 keys now, which are under construction or expansion at an investment of about 835 crores of capex, which is underway.
Right, got it. So, sorry, you just repeat that number. Room additions, sir. In the last, I think, 2.5 years or so, you've added 1,000 plus rooms. What's the plan from here?
So the plan is to go from 5,000 rooms that we have currently at the beginning of FY24 to go up to 10,000 rooms by about FY29, FY30. So in about 6 to 7 years, we want to take it to the double of what we have today.
Okay, and that 5,000 member addition run rate, I remember you telling us that it will happen sometime, next financial year. Do you have a firmer kind of path to that? 5,000 plus every quarter? Yeah.
So we are already tracking around 5,000 in the last 2 quarters. As you may have seen, we are very close to 5,000. Our aim would be to cross 5,000 as we move forward into the next 2 quarters. So we are definitely above the 5,000 run rate in our minds in terms of our preparations and planning. And we are also seeing great momentum in the membership additions in terms of consumer interest. And our new campaigns are also doing extremely well, the marketing campaigns that we have launched during the ICC World Cup.
Okay. You have a large expansion plan, I think overall capex of over 800 crores and 5 projects which are underway, but you also have large cash on your books, which is over 1,170 crores. Is the plan to fund this entire expansion with the internal cash, or would you look to raise some amount of debt?
At this moment of time, the aggressive plans that we have made in terms of building our inventory, we are very confident with the acceleration in the member additions. We will be generating sufficient amount of cash. Just to let you know that last year, we generated around 400 crores, roughly about 400 crores of operating cash. And as we accelerate our member additions, our cash is bound to grow. Even in this quarter, actually, our cash position improved by 40 crores quarter-on-quarter basis. And by the way, parallelly, we have added 53 crores to the deferred revenue. So financially, we are on a very, very good wicket. The debt continues to be at the standalone zero. So therefore, we are very confident of funding our capex through the accelerated member additions and the additional cash that we will keep generating. And you will see much more capital expenditure announcements. As you know that we have signed an MOU with Uttarakhand government for investing 1,000 crores over the next 3 to 4 years. And with many other state governments, the talks are on.
Will the EU business turn around in the second half, sir?
The EU business, specifically based out of Finland, has actually turned around even in this quarter. We faced a little bit of difficulty in the Swedish part of the business, and Swedish economy is not doing too well. So Holiday Club Resorts delivered 1.6 million euro EBITDA. And that is something, given the conditions over there, given the fact that the Russia-Ukraine war is on, the inflation levels are high, consumer sentiment tends to low. But you know what? Finnish people love to have second homes, and they are not able to afford second homes because of the high mortgage rates. So the timeshare sales actually went up by 7% in this quarter.
Any acquisition plans?
We are continuing to scout properties, and primarily in India, to buy so that we can accelerate our room inventory, while we are also buying land parcels and also going to be announcing more projects. I think you know that we announced a greenfield project in Thiog in Himachal. Last quarter, we had announced in Ganpati Phule. So our aim is to get more and more greenfields, expand our existing resorts, and also look at suitable properties for acquisition.
Okay, you were mentioning the European business just a while back, saying that there is a bit of a turnaround in places like Finland. But can you tell me when will the entire business, the EU business, turn around for you in terms of a timeline?
So I think another quarter we should be there, and quarter 3 is generally an okay quarter. Quarter 4 is looking very, very robust, with the Brits, Germans and Dutch already booking their holidays, winter holidays. As you know, winter holidays is a very, very big thing in the Scandinavian part of the world. And also the cost savings are also a lot of actions have been put in place. The management over there, working along with the management here, is extremely confident of having a very significant turnaround in Q4.
Okay, all right. We will leave it at that. All the best. And this is, of course, the season is booming at the moment for all of you in this industry. So hopefully that is something that should continue. Well, that's Mahindra Holidays with their future plans for the business. But for the market, it's not too bad, actually. The Midcap index has recovered, but it's turning out to be very, very volatile. There was that initial dip that we saw on the Nifty. Now there is that recovery. Look at the chart over there, and we are moving to the high point of trade. Mitesh is back with us. Mitesh, how are you approaching this volatile market, and what are the stocks to look at now?
Yeah. So I think this volatility will remain. Basically this still looks like a bounce back to the decline which we saw on Monday, and not only on Monday but a couple of days before that when we started falling from last Tuesday. And typically bounce backs are choppy, and you will see a lot of ups and downs happening during the day. So my idea, since it is to sell on rallies on the index, I would want to see Nifty get closer to about 19,400, 450 zones. That's where I would want to buy into put options. So that's the way we'll approach it. Till then we are, waiting it out. The other option could be the Nifty starts breaking 19,200, and then we go aggressively short. So that's the way we'll take it forward. On the stock side, I have one buy and one sell. Apollo Hospital could be breaking down from a range. So sell here with a stop at 49.75 for a target of 48.50. And UBL is something which did well on Monday as well. Now it's seeing good continuation. So that's a buy with a stop at 16.30 for targets of around 1,700.
Just one, Mitesh, on what's the view on the mid and small cap indices? Briefly, if you can touch upon those, because they
Yes,
look a little more vulnerable. Go on.
They do. In fact, if you rewind the clock 3-4 weeks back, the mid cap and the small cap indices were continuously making new highs, and they were also outperforming a lot. Now, both in terms of price performance and outperformance, both the mid cap and the small cap stocks as well as indices had stretched too far from their moving averages, from their mean levels, and I think it's just happening this entire move is happening as a mean correction. So while the Nifty is also corrective, the mid cap and the small cap in the short term could correct a bit more, but the long term picture remains very good. So I would be wanting to buy into the mid cap and the small cap names, but not now. I think maybe a week and a half down later. Once the correction or the pullback is over, then we'll look into it.
Okay, all right. Mitesh, thanks a lot for that. Let's focus on some stocks now. Mangalam is tracking Delta Corp, which has seen a bit of a relief rally. Mangalam, over to you.
It is a relief rally indeed for Delta Corp. They told the exchanges that the Goa bench of the Bombay High Court has directed the DGGST of Hyderabad to not pass final orders on the 16,200 crore GST tax notice that had come about in September itself. Remember, for Delta Corp, between September and October, there have been GST demands worth nearly 23,000 odd crores. And the Bombay High Court's Goa bench has said that, the DGGST should not pass final orders without the prior permission of the court itself. The company on its part had earlier indicated that they will pursue all legal remedies to challenge the GST tax demands and related proceedings. Turns out that there could be some relief in that. But however, these issues are long drawn, and we will hear the rest on that. For now, it is a positive and a relief rally on Delta Corp.
Okay, thanks a lot for that. Well, Keval Kiran is the other one that we're looking at this morning. Surbhi is tracking that one for us. Surbhi, over to you.
Thanks so much for that. So Keval Kiran is an apparel company which operates on the brand name Killer, and they have announced their Q2 results, and pretty strong results considering it is a seasonally weak quarter. The revenues were up 16%, the gross profit margin expanded by 130 basis points, the EBITDA is up 23%, margins are up 140 basis points, that came in at 23.5% versus 22%, and PAT is up 27%. Operationally also pretty strong. The revenue growth has largely come from volume growth as opposed to the value. Volume growth is up 19%, they've sold 38.5 lakh units. The sales realization are slightly lower by 3% on a year-on-year basis at 678 rupees per unit. But overall, strong set of numbers by Keval Kiran.
Okay, thanks for that. Well, Mahindra Logistics is the other one that we are looking at. Mangalam is tracking that for us. Mangalam, why is that?
The second quarter this time around was weak, largely because the shift that we saw in the festive season into the third quarter, and that's impacted their e-commerce business. That's not all. The global economic environment was not too conducive for the freight rates, and they've seen a bit of a drop as well. All of that has caused weakness in Mahindra Logistics' second quarter performance. The revenues grew by just around 2.9 odd percent, 1365 crores, but the operating performance was weak. The margins compressed from 5.1% to a little under 4%. The EBITDA was down 21%, and as a result of which, on the bottom line, the company reported a loss of 15.5 crores. This compares with a net profit of 12 crores in the comparable quarter. The company said that there were headwinds in the e-commerce segment, and they expect to see a positive demand uptick in the festive season. So as a result of which, the stock, which was lower, has now ameliorated a little, has recovered a little from the lows. But the question is, what kind of recovery will we see in the third quarter?
Okay, all right, Mangalam, thanks very much for that. 30 points higher, so we're basically around the levels where we've spent bulk of the day so far, which is not much, but 19,300 plus on the Nifty. We'll take a quick commercial break here. When we come back, we put the focus on the commodity segment, and Manisha is going to be here with that in just a bit from now.
Well, shifting focus to the commodity markets now, Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at metals as a sector, which has started the day on a positive note. Well, remember, the last week wasn't so great. And for the month of October, we still are headed for a negative move here. But the prices are firm because the dollar index has come off slightly. There are expectations that China would come out with a stimulus hope. The 1 trillion Chinese yuan of a figure has been doing rounds for some time, with the expectation that China will approve additional sovereign debt issuance there. We did see copper prices decline all the way to 692, but holding around that 700 mark on the MCX markets as well at this point in time. Apart from that, there also is support from the Asian equities, which have started on a positive note. The US earnings were on the stronger side as well, most of them, and that has led to some confidence coming in for metal as a sector there. So overnight, you saw the iron ore prices gain up by almost 3%. Copper gained 1.5% as well. For copper especially, we have seen the inventories market continue to run up on LME and Shanghai collectively. For the month of October, we have seen the stocks gain up by nearly 50%. So for the near term, there is enough stocks in the pipeline. For the further years, for 2026 onwards, markets believe that you could be looking at a deficit. And there are reports from Citi and Saxo Bank suggesting that an all-time high in copper in next 12 months cannot be ruled out. In the meanwhile, when you look at the month of October, as I said, we are headed for a weekly, monthly decline for many of these metals there. Copper, 0.5% on the lower side, aluminum 1.5%, and nearly 3% of a cut is what you are looking at in lead and zinc as well. For the markets, it is going to be the US Fed monetary policy meeting that is in the next week. But ahead of that, it is going to be about the GDP data and also the inflation numbers that come in this week that the street will take cues from.
Okay, thanks a lot for that. Let's slip into a quick break. On the other side, our special segment, it's the economy. Lata will get chatting with Ramani Dati, the CFO at Team Lease Services, and Vijay Sivaram, the CEO at Quest IT Staffing, to discuss the hiring picture across industries. Stay tuned.
Welcome to It's the Economy. IT companies, the largest hirers in India, reported their sharpest fall in headcount in the quarter gone by, Q2. The top four IT companies, TCS, Infy, Wipro and HCL Tech, between them reported 22,000 lower headcount. By now, I know the numbers well. TCS, about 6,000 jobs. Infy, 7,250. Wipro, 5,000 jobs cut. And HCL Tech, 2,250 headcount lowered. Now, what's more, TCS and Infy indicated that headcount will fall in the current quarter as well, Q3. And several IT companies have also indicated they won't go to campuses this quarter to hire. So is the lower hiring only an IT sector issue? Are other sectors also slackening the pace of job creation? I have with me two hiring company honchos to answer this. Ramani Dati, the CFO at TeamLease, and Vijay Sivaram, CEO, IT hiring head at Questcorp. Vijay and Ramani, thank you very much indeed for joining me. Ramani, let me start with you. IT, what is your record showing? Because yours is a July-December survey. Did IT companies surveyed tell you they are hiring less? And are they the only companies hiring less?
Yes, Lata. So as of now, IT companies are the only segment where we are seeing a drop in overall hiring trends, because the rest of all other industries, be it banking or consumer segments, telecom, across all industries, we are seeing good trend on overall hiring at entry level as well as mid and senior level. IT, we have been seeing this for the last few quarters, and it looks like this trend may continue into future quarters as well. And as you have rightly mentioned in your opening remarks, so we have started seeing a drop in attrition backfilling as well, because so far, at least the IT service companies have been backfilling the open positions on account of attrition. But even on that, now there is a slowdown, and we are expecting even in fresher hiring, at campus level hiring, there'll be a drop in the overall hiring trends.
Okay. Now, in your survey that you shared with me, you said that the overall hiring across companies, not counting just freshers. Freshers, you clearly said that the hiring, 65% companies said they will hire versus 62 in the previous 6 months, Jan, June. What about overall hiring? You gave me a 73% number. What was the overall hiring percentage in the first 6 months?
So the overall hiring compared to last 6 months, we are expecting the next 6 months, this 6 months will be better. This is including IT, because as I mentioned, other sectors, especially because of the festive season, and also we have a good monsoon this year. In all other non-IT segments, we are seeing good hiring. So that's why we have reported that there'll be a substantial improvement in overall intent to hire in second half of this year. However, as I mentioned, in IT, we are seeing that slowness to continue.
Okay, Vijay, you're a specialist in the IT space, but first an overall question. Do you share the same positive feedback? Lower in IT, but not in others?
Well, good morning, Lata, and thank you so much for having me on the show. Well, I'd like to break IT into 3 parts, Lata, honestly. The IT services hiring is definitely on a low. And without a doubt, I think we are continuing to see a lack of replacement of hires, new hires, as well as replacement hires, like Ramani mentioned. But we continue to see some fair amount of a neutral behavior or some amount of small growth happening in the GCC sector for technology hiring. Compared to that, the non-IT hiring, we're seeing a huge uplift on the retail and e-commerce. This is the holiday season, so we are continuing to see a huge uplift there. Manufacturing is on a roll. BFSI is on a roll. So the non-tech hiring is pretty much there or ahead. But the IT service, I think, continues to see a slowdown. And you must remember, this is also the quarter where budgets are reviewed, spends are reviewed. This is towards Christmas, holiday season in the US. So you will see a continual form of being slack for the quarter ahead. And hopefully Feb, March, will slowly see some form of growth.
No, we go through this furrows and long leave every Q3, but IT companies have never told us that they have reduced headcount and that they will reduce headcount and that they will not go to campuses. This triad combining together is a new from the IT space for us. So, I mean, what about non-IT companies' tech hiring, Vijay?
Well, that continues to see a fair amount of traction. I think for 2-3 reasons. A lot of the Indian enterprises are seeing the digital push happening in a big way. So while they will never see the volumes that you would see in an IT services firm, but in comparison to a year-on-year format, you will definitely see a upswing in Indian enterprises that are going the digital way, number one. Number two, there are a fair amount of organizations in the ecosystem today that are ramping up their own technology wings for their own improvements, cost optimization, or ERP, SAP enablement, etc. So you're seeing a large amount of hiring that also comes there. But I repeat, Lata, you cannot compare the volumes that you see in the IT enterprise sector vis-a-vis the services sector. And they will not hire a lot of freshers. They will hire more laterals, 3 years, 4 years, 7 years. They will not hire a lot of freshers.
Okay, so a lot of tech demand, but not so much among the freshers. And of course, total doesn't add up to IT. Ramani, what kind of your survey tells me how many companies are going to hire. But it does not, do you also take data on how much they will hire? It's quite possible that 73% companies told you we will hire, but they are not going to hire as many that they hired last year or in the first 6 months. Is there any way you can get data on number of hires?
Number of hires on a 6 months basis, it's very difficult to kind of get the survey, Lata, because typically the open positions in non-IT segment, we get to know only 60 days in advance. So compared to 60 days segment, over the last few quarters, there we are seeing an uptick. And also the 73% that we are talking about as number of companies intend to do hiring, there is an improvement compared to last 6 months. And overall, the number of open positions, as I mentioned, because of the festive season and also because of good monsoon, overall, we are seeing a good improvement. And we believe that this 6 months, the number of hirings will be higher than the last 6 months as well.
Okay. So the number as well as the number of companies is higher. That's extremely good to hear. Also, Ramani, I wanted to know, you gave us, you've obviously done the survey last 6 months, asking them what will they do from July to December. Do they actually hire that much? I mean, after all, you already have 3 months of the current 6 months with you, July, August, September. Is the actual action in keeping with their intent or even better?
So far, more or less, we are in line with the actuals and our trend lines that we have projected. And this festive season also, we believe it will kind of align with the survey that we have done. Maybe few sectors may kind of overperform on the trends that we have projected, especially BFSI, consumer, retail, those segments we believe can do better than what we have kind of indicated in the survey. And also within IT, as Vijay has mentioned, in IT services, we are seeing a slowness. However, GCCs, ODCs, the back offices, so there we are seeing an improvement in demand because this is a structural change that is happening because of the global slowdown. And all these global companies coming under cost pressures, they are kind of talking about setting up and expanding their base in India for the IT talent pool.
Okay, so GCCs are doing well, but IT companies are hiring less. Right? Is that what you're trying to say?
That's right.
Now, yeah, very much what Vijay also was telling us. Vijay, I wanted to know about salaries. Now, if total fresher demand is less, then are those who are hiring offering less salaries?
So very interestingly, if you look at it, Lata, over the last decade or so, the fresher salaries really haven't gone a mile ahead. I think the fresher salaries have always been between 3.5 to 5.5 in terms of overall composition package. Of course, there will be outliers with the larger players offering much more. Pure play captives, the IITians get a lot more. So I'm just saying with the regular tech fresher segment from tier 2 colleges, the salaries have been more or less the same. I think what will happen now is that you will see a lot of freshers getting lesser demand in terms of positions. So they may tend to go for lower salary jobs in startups, or they may go for a few other roles which may be IT enable linked jobs as such. So it may not be they'll always pick up a software job, which was plenty 2 years ago when the surge happened as such.
Okay.
So you will.
So fresher salaries may be seeing a downtick, you're saying?
I would say it's a neutral towards a little down, but I wouldn't say it should be that worrisome. It's the volume of demand that's coming down, Lata. And with the volume of demand coming, that will push people to maybe move outside of pure software roles and move into some IT-enabled roles, back office roles, which may tend to take their average salary come down as such. That may be one impact per se.
Okay. What about salaries generally in the tech space that you track very closely? Are salaries rising as much as they did last year, or are they rising more? Any salary trends that you have noted?
Well, salaries, so let me break this into 3 periods. There was the COVID period where the salaries, where the hiring was very less, and there was a lot of constraints in terms of talent positions as such. But when the surge happened post-COVID, there was a significant spike in salaries. So overall, if you notice the average cost to hire as well as the average salary paid went up by quite a notch. So those salaries are not going in those percentages anymore. We saw hikes of 100%, 80%. I'm sure you remember those days.
Yes.
Those are not happening anymore. We still are today seeing between 15 and 25% hikes from an external hire standpoint. So you would see that high salaries per se for an internal appraisal format will not go beyond 8 to 9%, and an external hire will go between 15 to 25%. Now, what is important, Lata, is what kind of people can take higher salaries. So if you look at skills such as the generative AI skills, the data, the analytics side, high-end cloud work, high-end full stack development work, these kind of works, I think, can still command a fair amount of salary premium. Compared to, let's say, an infrastructure support role or a testing role, those roles may not enjoy that much of a premium in comparison to, let's say, a new age role that's coming into the market in the last 2 years, where the demand is still fairly good.
Okay. Very quickly, Ramani, your take on salary levels in the last, say, July, August, September. Have you seen any dip, any rise?
In non-IT, there is no dip, Lata. So it's the same 4 to 6% of salary inflation, which is in line with the historical trend. IT, we have seen relatively a lower trend on salaries. I mean, I can't say that they have already plateaued, but at least there is no demand for a higher salary in terms of hike. As Vijay indicated, it's still around like 10 to 15%, not like 20-25% what we have seen last year.
Okay, we're out of time, but that's giving us plenty of fat to chew. That the headcount lower that we saw in the IT industry is IT industry specific, and IT job or tech jobs in other industries are secure, and non-IT, non-tech verticals are continuing to hire as before. Salary increases, not much to choose. Perhaps tech fresher salaries could get lower because of the lower demand for them. But otherwise, there isn't a dip in salary trends. It is as usual. It's not an extraordinary rise, but it looks like it's following the secular demand. That is good to hear, which means consumption should not see a setback, except for in small IT quarters. We have to wrap up on Bazaar on that note. Vijay, Ramani, thank you very much for joining this very important chat. Chartbusters coming up for you after a break.
Nita Mukesh Ambani, the founder of Reliance Foundation, speaks about her new cultural center.
It's taken us now a decade to bring this to life, to show the best of India to the world and get the best of the world to India.
On the Reliance Foundation,
a nation's development depends on women empowerment and the well-being of its children.
On family,
I am so blessed to have Mukesh, who is my best friend and my life partner.
Nita Mukesh Ambani sits down for the CNBC conversation.